Good Monday morning, everyone. It's November 22nd, 2015. In this week's video, I'll review the SPDRs ETF, crude oil, the US dollar, consumer discretionary, and technology. But before I do so, some housekeeping. First, I want to remind everyone to visit the website at least once a week to catch up on our most recent performance and to visit our blog section. As most of you know, the blog section is an avenue where I share with you my views and expectations of the broader markets, and it's also a place where I share from time to time my views on particular or important events that I think need to be discussed more than they usually are. In this week's blog post, I shed some light on some of the shenanigans that goes on and off in Wall Street, and particularly as it relates to some of the stories surrounding Valiant and Draft, and how these stories are very similar to the stories that broke out in 2012 and 2011 with Keurig Green Mountain Coffee Roasters and Herbalife. Essentially, it's the same story being narrated time and time again, just with a slightly different sort of twist in the plot, and sometimes, but not always, with different characters. These trading heists, or it's we have to call it for what it is. It's white collar crime. Should not happen, and yet they happen. The sort of the frequency of these events seem to be happening much more often today than they did just a short few years ago. So the fact that people have forgotten altogether about these events, um, or just turned a blind eye for personal reasons or whatever it may be, really again calls into question the role as we as investors play in the marketplace, and the role of some of the bigger fish, some of these activists and billionaires, their role they play in the markets as well. So again, by writing this blog post, hopefully I can get people to question more some of these price discrepancies we've seen in some of these stories that have broken out recently, and in doing so, it will drive you again, sort of not get caught in these you know massive price declines, really, which are just destroy wealth at the seams quicker than you can even say whatever. And also again to focus your mind on winning trades and hopefully um, sort of avoid these traps, and again implement better trades going forward. So if you're interested in reading the blog entry, you're more than welcome to just visit the website. And if you're strong minded and have a strong opinion as I do, make sure you leave a comment. The only thing I do ask for is that it's respectful and that it sticks only to the subject at hand. Okay, that's the only two requirements I have. So the second point I wanted to bring to your attention is to I wanted to introduce a blog forum where I tend to post my ideas and expectations about individual stocks from time to time. And the website is called hotstockmarket.com. It's a financial message board where really it convenes, a lot of people, a lot of investors with different backgrounds, different experiences convene to share their experiences, their thoughts about the broader markets. Perhaps the most frequented and posted thread of all are the weekly threads, which again is a place where people share their ideas about the week's events and how they're approaching the markets given their set of strategies. So if you're interested, want to exchange ideas with other like-minded investors, make sure to drop a line. First, join of course, and drop a line, and I'm sure everyone will be happy to have you on board. Um, while there, you can also type in SmartStocks, and it'll redirect you to the SmartStocks thread, which is basically again a place where I share with you my views and expectations of the markets. It's also a way to sort of access the weekly videos I put up every Sunday, and some of the blog posts I also share on a month-to-month basis. So again, if you're interested, make sure to visit the message board and let us know how you came to find about the message board. And again, just make sure to participate. These people are very welcoming. They're there to support you in any way possible. And again, it's a great tool, or to sort of not supplement, but to really uh, build on your trading. So, with that said, let's take a quick look at chart of the S&P 500. As usual, I've included a few Fibonacci retracements to sort of give us a better understanding of what markets are doing today. Um, I'm sort of going to divide this in, I'm going to sort of divide this into the good, the bad, and the ugly. The good so far in the S&P 500 is that fact that the 207.60 levels on the spiders, which was a level I mentioned a few weeks back, held this week. Even though we pierced and closed well below that price point last week, the fact that the market bulls rather managed to not only pierce but close well above this pricing point keeps the door open for further upside shorter term. Remember that if there's going to be a positive carry through effect from the move we got off the October lows, 207.60 spiders, which equates to roughly 2080 S&P 500, has to hold. Otherwise, we're basically back to trading in a wider trading range, in a 260 to 270 point trading range in the S&P 500. We would have to wait until the first, possibly extending into the second quarter of 2016, if a breakout of any kind were to materialize. So the fact that again we managed, or market bulls managed to end the week above 207.60 bodes well if you're someone who's trying to play um, the markets from the long side, at least short term. That said, if next week, which let me remind you is a shortened trading week because of Thanksgiving, markets will be open Monday through Wednesday. They'll be closed on Thursday, and then they'll be open only for till midday rather on Friday. So even if it's likely to be a low volume week, but if for some reason price sort of falls back below 207.60 on the spiders, you have to remain cautious and not hurry, or sort of not hurry any trade you may be looking at to place to the long side. There'll be a time and a place where you can place that sort of long bet later on in 2016. But if 207.60 holds on the spiders, then by all means, I think it's perfectly fine to trade the market to the upside, but only on those sectors that have performed the best year to date. Um, Principally because money managers have underperformed the markets year to date, will have to rotate out of those losing positions into winning positions. That even though it doesn't really make much sense, it's a self feeding mechanism, right? Where essentially everybody's thinking the same thing, they pile on the same trades, and it's an easy way to make money because everyone's mindset is the same. But you have to be mindful of two facts. There's still risk by placing that trade. It doesn't mean it's a guaranteed trade, or you're gonna earn a guaranteed profit. And the second thing is, you have to realize again, it serves you no good to participate in the trade, leave it open, thinking that it's gonna last forever, and not close out a trade for a profit. I mean, I know this may sound very basic for most of you, but you'd be amazed at how many people actually don't close out winning positions and actually realize a profit on those trades. So just be mindful of that. You still have to be very careful and select your spots as you normally would do. So just be mindful of that. Heading in 2016 or into the first quarter of 2016, you could probably swing back into some speculative small caps. But until then, I would still clear small caps and focus largely on large cap stocks, which are likely to boast the best returns going into year end. The only way I would get cautious about the markets is if 198.60, which is roughly 1975 on the S&P 500 cash, gets closed below on a week to week or a month to month basis. That to me doesn't necessarily mean I would short the market with both hands. It would just mean that any upside is going to be largely impaired by continued weakness into strength, which is a theme we've seen really since the late August breakdown. So for now, again, the short-term trend and bias remains to the upside. It remains bullish, especially if the S&P remains above 207.60, or on the spiders rather. But again, that element of risk is still there. The only reason or the only way rather, I would short the markets with both hands is if the higher weekly low between 1910 and 1920 S&P 500 gets taken out with a vengeance, or with higher daily and weekly volume, and proceeds to take out the October lows at around 1880. Only then would a bigger breakdown be afoot, and again, would I be comfortable shorting the market? As far as the U.S. dollar, you know, for those of you who have followed these weekly videos since the beginning, you know by now that I'm been a long-term bull of the dollar, and I remain so. I mean, this original trend line price not only reclaimed and traded above this original rising trend line, but it is also, the U.S. dollar is trading back above the 76.4% fib tracing, which speaks to the relative strength um, of the trade. So, while it's fairly reasonable for this original trend line to get contested once, twice, and possibly three times before new highs are made, it doesn't mean you want to, in case of a shallow break below the trend line, be on an intraday or on a daily basis, it doesn't mean you want to short the dollar. Um, so, just be mindful of that. I still think, just like the market, though, the U.S. dollar needs time. I wouldn't say new highs are here to are imminent, not unless there's a bigger debacle in the euro, which comprises roughly 40% of the GDP. Until then, again, I would caution against, or I would err on the side of caution and sort of fade any rally and buy into measured dips coming off this trend line. As for the USO, or the proxy for the crude oil, it doesn't look very good. I mentioned a few videos or a few weeks back how 1420 USO had to hold if there's going to be any sort of positive carry through effect coming off that massive bullish engulfing candlestick set in the last week of August. Notice how price rebounded multiple times off that 1420 level, but never really proceeded to make it or establish a higher low and a higher high. That bodes short term extremely bearish for crude oil, but it doesn't mean that I would, if you missed the price breakdown coming off this 1420 level on the USO, it doesn't mean I would go ahead and short the oil. The only way I would short oil is, again, if these lows are taken out with higher daily and weekly volume. But even so, even if the lows are breaking low, you have to, again, earn this high of caution and remind yourself that it could be a sort of a fake out move where price trades below that price point for a few days before it reverses sharply back into this value zone, which price is just not creating. So, what are my views? I don't think crude oil breaks the year-to-date low this year. It may possibly break those lows early next year, but I would use any weakness in crude oil as a buying opportunity. I don't see crude oil trading or trading in and out of the $30 handle for a prolonged period of time. Um, so that's what I would focus on crude oil. With that said, if you're entertaining the idea of possibly going along a few oil names, resource names, or even material names, again, you have to err on the side of caution and be very, very careful. Um, I wouldn't necessarily use stops because clearly they've been gaming both ends of the trade here ever since we got that notable price breakdown. But I just wouldn't jump in with both feet and buy some of these resource names. Not until 1420 to 1423 USO gets gets reclaimed in fairly short order. Until then, again, you have to be very careful with oil. With that said, if the S&P is going to make any appreciable new high, crude oil or energy resource and material names will have will have at the very least have to participate in the rally. In other words, it will have these sectors will have to match the performance of the S&P 500 into any rally, with some of the leading sectors, which, as you all know, technology and consumer discretionary being the two leading sectors as of today, with those sectors continue to lead markets higher. On that note, technology looks bullish again. The breakout we saw take shape 3 weeks ago. It still holds. Even last week, many people questioned last week's or the breakout rather we got 3 weeks ago. But with this week's piercing pattern, weekly piercing pattern, it not only reaffirms the breakout we got 3 weeks ago, but it solidifies 4205 or thereabouts as a higher uh, weekly and higher daily low. In other words, a new pattern seems to be emerging on both the daily and weekly charts for some of these leading sectors. It's not emerging for all sectors. It's just emerging from some of these leading sectors, which is extraordinary. It's, I wouldn't say it's extraordinarily bullish, but it's definitely a welcoming sign for market bulls, because what characterized the markets all year long was the fact that there was a trendless market that was range bound, right? And if we begin to see a new series of higher lows and higher highs being sort of established on the daily and possibly on the weekly time frames, that sort of speaks to the other missing element of the market, which was a lack of commitment and a lack of conviction by investors. So if price is acting better, it means there's a higher commitment and conviction by investors at higher prices, which is what essentially is what needed to push markets higher. So that change in attitude, that change in approach by investors, while we still need some confirmation. Again, it bodes extremely well if it can hold. It's the same story if we look at something like consumer discretionary, which is also set a piercing pattern on the weekly and seems to be forming uh, uh, a new series of higher lows and higher highs on both the daily and weekly time frames. Again, the only way this pattern would be confirmed is if the current highs for each of these sectors get taken out in fairly short order and the S&P 500 proceeds to trade against the current high around 2132, 2133. So that's basically all I have to say. There's really not much new to say. Not much has really changed. Breadth is improving. Market internals are also sort of widening, which is a good signal. But we still don't have confirmation, and I fear that until we get that confirmation, even if it means 40 to 50% of the move has already been is gone, I would rather make money in the remaining 50%, knowing that I have a higher probability of success than just sort of guessing what price may do. So that's basically all I wanted to say about the markets. Again, next week is a short week. Be careful. There will be opportunities. You just have to be very selective and pick your price levels with much care. With that said, I want to thank you, excuse me, for taking the time to watch weekly videos. And I will post the next weekly video on Sunday, just to make sure, just so that everybody's on the same page. I'll post weekly videos from now on out every Sunday. So just be on the lookout for that. So again, I want to thank you for taking the time to watch the video, and I wish you good luck.